And welcome everybody to another Smart Money Circle show. I'm Adam Sarhan. With me today is Gregory Sachs, who's the current founder and CEO of SCG Asset Management, but he also was the founder, chairman, CEO of Deerfield Capital, which he sold, well, had 17 billion in assets under management. So Greg, absolutely phenomenal job there. And he sold years ago, and now he's set up with SCG Capital. I'm very interested to hear your story. Thank you so much for coming on the show.
Adam, thanks very much for having me. I'm excited to be here, and I look forward to our discussion.
Beautiful. So I always like to begin, Gregory, can you tell us a little about your story and how you got to where you are today, please?
I would be delighted to, but if it's okay, I would like to satisfy our attorneys by just kind of reading our disclaimer, if that would be okay with you.
Please, by all means, please.
Thank you. SCG Asset Management LLC is a registered SEC investment advisor with a fiduciary duty that requires it to act in the best interest of clients and to place the interest of clients before its own. However, registration as an investment advisor does not imply any level of skill or training. The information in this discussion is for informational purposes only and is not intended to provide specific advice or investment recommendations. All investing is subject to risk, including the possible loss of your entire investment. And of course, past performance is not indicative of future performance.
Thank you very much. The disclaimer is very, very important. Thank you for getting that out of the way.
Thank you. They will be proud.
Yes. So how'd you get to where you are today, please?
So, I don't even know where to begin. I'll begin. I focused on the quantitative side of the world academically. I studied actuarial science and quantitative analysis, and got a master's degree in quantitative analysis and finance, and then ventured off into the financial management world. After I ended up in Harris Bank, sitting on a milk crate with no assets under management. The SVP at the time was focused on the currency desk and said, "Greg, do whatever you want, but don't lose more than $50,000 a month." So I used that time to actually travel to Europe and learn the fixed income arbitrage business globally, and built a fixed income arbitrage group for Harris Bank, which was then acquired by Bank of Montreal, BMO. After several years there, I developed some interesting models and started Springfield International Investments. And that was backed by a wonderful Hong Kong family, the Chan family. They put up $15 million in capital, and they said, we'll be your partner, and go build the business. So then I ended up trying to figure out what is the best strategy and what's the best way to communicate the strategy, and learned all sorts of very interesting things. And this was back in 1993, where hedge funds were not that popular. And so it was really important that, for me, that investors understood what they were investing in. And so at the time, we were investing in yield curve arbitrage opportunities, buying a 2-year note, selling a strip of euros, what we used to call the TED spread.
Yep.
Those kinds of transactions, very complicated to explain to somebody who is not familiar. And so what I did is develop a story. I basically said, look, you invest with us in order to take advantage of a flight to quality. So when investors get out of their equities or emerging markets or more risky investments, they buy short-term treasuries for protection. And when that happens, our spreads widen and we do well. In the meantime, we'll make some positive carry and hopefully generate, an above LIBOR kind of return.
Mm-hmm.
And so when 1994 occurred and Mexico devalued, I believe that's when Orange County declared bankruptcy or defaulted on their debt, and a couple of hedge fund managers exploded. We were up 22% and performed very well, and that was the start of our career, of our fund and our business. And then as we developed further, it became very clear that internal controls and audits and those kinds of things and the hedge fund level should be audited. So we were the first people in November of 1995 to have our internal controls audited.
Nice.
In order to, again, provide comfort to investors that, all of our operations, risk management, et cetera, was in solid shape. So as we continue to build that business, we expanded into CDOs and CLOs, which are types of structured products. And I sold 20% of the business to Sumitomo Life Insurance in 2001, and their management team was very excited until the board, the guy on the board ended up having a stroke. And anyway, all sorts of crazy stories, but it turns out that I bought them back out in 2004, and I sold 65% of the firm to Nelson Peltz.
Wow.
And his group at Triarch. Wonderful guy, had a terrific experience, sat on the board, which is now Wendy's, for about 3.5 years. And then Nelson wanted to leave and start his own investment management firm, an activist fund. And so I also retired from Deerfield. We changed the name at that point to Deerfield Capital Management. And at the time, we had 17 billion under management, and it was a very good run. I've been very blessed with many good years, but I'll tell you, Adam, I've never been blessed with an easy year.
I love that.
and so so since then, I've been managing my own capital, and I did a SPAC. Back when SPACs were not in flavor and nobody knew what they were, and they felt only the weak and the C- companies went public via SPAC. I was able to get a SPAC done. 5 years later, I took the company private that I had SPAC'd public as well, and had been investing my own capital. And then in 2019, I started investing in structured notes personally. And, I don't know how familiar you are with structured notes, but the kinds of notes that I was investing in were these single stock referenced assets. Mm-hmm. So somebody would say, if Tesla does not fall by more than 50% in the next year, you will get a 35% coupon. And so there are all sorts of intricacies, but that's the general theme.
Yeah.
And I found that to be very compelling. And then, of course, I took a step back and I said, I don't like the idiosyncratic risk.
Right.
I'm not comfortable putting all my eggs in one basket or just investing in the name Tesla. Mm-hmm. So what I think might be interesting would be to create a portfolio of these notes. Mm-hmm. So now the question is, well, how do you create that portfolio? Right. I can say, well, I like Tesla, and I like Apple, I like whatever other stock you like.
Microsoft, Nvidia. Yep.
Microsoft and so forth. But I said, there's got to be a better way. And I went back to my roots, which is quantitative. And I hired a team of PhDs in mathematics and statistics and spent a 1.5 years developing algorithms in order to best create a portfolio that is optimized of structured notes. Mm-hmm. And the math is very different than creating a portfolio of equities, because we're not trying to predict what's going up. We're trying to predict what's not going to drop by more than 40 or 50%. It's a different mindset. Yes. And so we were able to do that very successfully. And I thought the best vehicle for managing this strategy would be an interval fund, because the interval fund is a fund that's available for the retail private wealth group. And it's also allows for some liquidity on a quarterly basis, but the liquidity is capped
Right.
so that the fund doesn't have to go into a panic at all for liquidations.
Mhm.
So it was a perfect vehicle, and I was able to take over a interval fund that was being managed by Ladenburg.
Oh, wow.
And so that fund had been around for a while, and it only had 15 million under management. So we took it over, and we went through the proxy process, and we started managing the fund in January of 22.
Mhm.
And at that time, it had a whole bunch of legacy assets. So it took some time to get our strategy implemented, and all of the legacy assets, which were all illiquid type of non-traded REITs and BDCs, et cetera. And so now we're finally at a point where the fund is pure in its strategy of diversified structured notes.
I love that.
And that's the story
I love
in a
that.
nutshell.
Yeah, that's beautiful. Thank you for that great story. So, Greg, from is the fund publicly traded? Like, there's a ticker, like an ETF, or is it private?
Yes, the ticker is LTAFX.
Beautiful.
And it is publicly traded and available through RIAs. It's on Fidelity, Schwab, Pershing.
Beautiful. Well, thank
all
you
the
for
big
that.
ones.
So let's shift the conversation a little bit and discuss risk. How do you manage risk, and what mistakes do you see people make with respect to risk management?
So the ultimate risk management tool for this particular fund, and for me in general, is just the concept of diversification.
Mhm.
The major problem that people make is they get married to an investment. They get married to a position. I
Right.
love XYZ stock. I love XYZ investments.
Right.
And they forget to ask themselves the very important question of, what's the worst that can happen? And if it happens, can I handle it?
Right.
And if you take any public company out there, I'll let you pick the example. But if you take any public company out there, we could all come up with an example of where that company could have a significant drop in its equity price.
Right.
It may be a low probability, it may be highly, highly, highly unlikely, but the probability is not zero.
Mhm.
And so ultimately, the way we manage risk is we diversify, and we don't have more than 3 or 4% of the fund in any one note.
Okay. Got it.
And this way, even if the security does surprise us, the position size will be ultimately protected. It will ultimately protect the portfolio's value.
Gotcha.
And then we do all sorts of other quantitative shocks and other mathematical approaches to making sure that we're properly diversified, that our portfolio is uncorrelated as it relates to positions within and as it relates to the market, and so forth and so on.
Gotcha. 100%. Beautiful. Well, thank you for that overview. So it's a diversification, take smaller positions. If one position, even if it goes to zero, it's not going to impact the overall fund, because the position sizing to begin with handles the risk beforehand. It's identified.
Right.
Got
Now,
it.
there are people that will argue that too much diversification will give you the market return. I think that's true across all asset classes, but I think if you're very specific within one particular style, I think a 2 to 4% position size is the right diversification.
Gotcha. 100%. Beautiful. Next question for you, Greg. What are some timeless lessons you've learned along the way that you'd like to share with the audience?
I think the one I mentioned earlier is, you ask yourself, what's the worst that can happen and can you handle it?
Right.
Is just a great lesson. I've also learned through mistakes by not trusting my gut.
Okay.
And that has to do with hiring and letting go staff. It has to do with investments in my portfolio. It has to do with, if I'm buying a private equity deal, who's the manager, who's the CEO, Going with my gut in the end has always seemed to be the right decision. And when I didn't, it ended up haunting me.
Wow, I
And
love that.
then the other mantra that I seem to come back to is the concept of fail fast.
I love that.
We're all going to fail.
Right.
Anybody who stands up and says, "Oh, I never fail," I run.
Got
I failed and I failed often, but the key is to fail fast.
got it.
And a lot of people don't implement that. It's easier said than done. If you hire somebody and a month later you just don't think they're the right person, don't wait a year and a half in order to make the decision that they're not the right person. Fail fast.
Yeah.
And it's the same thing with, an investment. If you have a bad investment, don't be afraid to take a loss.
Gotcha.
There are too many people, and I love my father to death, and he's an amazing man. But he once said to me, he owned some stock, and I said, how are you doing on this position? He says, well, it's 50% less than I buy and then I paid for it, but I haven't sold it, so I didn't take a loss.
Right. Yeah.
And so that mindset has gotten a lot of people in a lot of trouble.
Big time.
So I let the winners run, and I try to cut the losers quickly. And then the concept of fail fast, I apply to all aspects of my life.
Oh, I love that. So I just read, it's funny, synchronicity sometimes how the universe works. Greg, you're speaking to me about this really important topic. Peter Lynch had a great line in his book, and then Warren Buffett called him in 1989 and said, "Hey, I need to use this in one of my annual notes." And Lynch had basically said, let your winners run and then sell your losers, fail fast, right? And he said, if you don't do that, it's kind of like cutting your flowers and watering the weeds in a garden.
That's extremely well said.
Yeah,
That's exactly right.
Buffett read that.
And when you think about it,
Yeah.
if you're right half the time and you're wrong half the time,
Mhm.
if you cut the winners quickly and if you cut the losers quickly and you let the winners go, you should still end up with an attractive return as opposed to the opposite.
Gotcha. 100%. Yeah, that makes perfect sense. So what are your timeless lessons, timeless mistakes that you'd like to share with the audience that we haven't covered yet?
So, I think that one of the biggest mistakes that I think I've made early in my career, and I was very blessed to realize it, is this whole concept of ego.
Yeah.
What I've learned early on in life is that ego is a liability on your balance sheet.
Yes, it
And
is.
as soon as you get rid of it, your net worth goes up financially, professionally, emotionally, spiritually. Every aspect of your life changes when you lose that ego.
Mhm.
And so that's kind of I would say a lesson. That's kind of advice I'd give my 30-year-old self. But I was very fortunate that I learned the lesson the hard way, like most people, and I was fortunate enough to be able to get rid of it and benefit accordingly.
No, I love that. So that was my next question. The best advice for the 30-year-old self, and the ego side is so huge. Being humble is it's a superpower. It really, really is.
It's a super fun.
Yeah.
And some other 30-year-old self advice is enjoy life every day, and that's in today's world. I notice this with a lot of people. They tend to be enjoying life a little bit more so than the saying would go. But certainly when I was younger, I'm 58, so I'm not that old, but I'm old enough to at least remember. It was day and night. You're working 12 hours, 15 hours a day, and you'd come home and barely get to see the kids, and it was working weekends and traveling around the world and nonstop. And so if I could go backwards, I would say put the cell phone down at certain times, enjoy the family, enjoy time with your friends. Today's world, they may be putting it down a little too much.
Understood.
But the happy balance is the key. And I think that's, it all comes down to balance. The other advice is life is precious and it's very, very short. And I think as you get older, you realize the preciousness of it. when friends and family become sick and have issues, you realize this is one shot, and make the most of it.
Oh, I love that.
And then a couple of other things is that patient capital. I have been more of a trader in my life than I have been an investor, and spent my life kind of looking for the edge, trying to get between the wall and the wallpaper.
Yep.
And I think longer term patient investing will win the race.
Yep.
And so, that's another piece of advice I would have given myself. And the whole concept of compounding capital, which people understand by reading about it, but you really don't feel the power of it unless you focus on it and pay attention to it. And so that power of compounding is real. And that's advice that I wish I would have given myself. And last but not least, keep a great Rolodex.
Yeah.
Develop good relationships, build them, and then and keep the Rolodex. And I kind of have tricks because I don't remember names very well. So I will put in the context, I'll put plumber, electrician,
Yeah, me too.
whoever it might be. Obviously relate that to
Yep.
investment banker, etc. And so building relationships and keeping a detailed Rolodex will pay off when you're in your 40s and 50s.
That's such great advice. I do the same thing when I save anybody on my phone. It's okay, Adam Plumber, Tony, whatever the case is, and so on and so forth. So
Exactly.
yeah. Even with my kids' friends, the parents, I'll put the kid's name because I see the kids more often than I see the parents. So I'm like, okay, XYZ daddies, whatever it is. Love that. Well, Greg, this has been absolutely fantastic. What is the best way for people to learn more about what you do or get in touch?
So we have a website,
Mhm.
and it's SCG, which website? SCG LLC .com.
Okay.
Sorry, SCGAM LLC, SCGAM LLC.com is our website. And the fund that we manage is LTAFX, and it's available on the through investment advisors only, since it's an interval fund, and it's available on Schwab, Fidelity, Pershing, and a couple of other platforms.
Love it. Well, Greg, thanks so much for coming on the show, and hopefully we'll have you on again soon. This has been fantastic.
Adam, I appreciate it very much, and congrats on a great book.
Thank
Look
you.
forward to reading it.
Thank you kindly.
All the best.